and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. As investors, we Indians have understood the power of equity and, of course, equity mutual funds over the years. We've seen the wealth effect at play. So while we rush to buy the dips in the market, the question I'm asking today is, do we give enough thought to creating a well-balanced portfolio? Do we give enough attention to asset allocation? Markets can be volatile and life can be uncertain. Are we prepared? What should be the asset allocation and portfolio construction strategy, not for 6 months or 1 year or even 6 years, but for long periods of time as we look forward towards planning our wealth and our finances? That is what we're discussing on the show today. And helping me answer a lot of these questions, I have two guests joining me. We have Mr. D.P. Singh of SBI Mutual Fund and Feroze Azeez of Anand, Rathi. Well, gentlemen, thank you so much for joining in. I know I'm raising some boring textbook type questions, right? Because these days investors just want to know what's the next hot fund to buy, and they want to sort of leave it there. But that's why I think we have this show, because we want to have more in-depth conversations, ask the big questions that investors need to sort of ask themselves. So thank you so much for joining in. DP sir, let me start with you. Opening thoughts. Why is it that we need to go beyond just the next hot mutual fund?
No, because see, investment is as you said, boring, but very important, very responsible thing to do, because you are investing for your future, you are investing for the next year, which is very, very uncertain. So you have to do it very, very responsibly. Don't look at it, because whosoever is looking at the hot things is likely to burn the fingers also. So don't do that. Do it in a responsible manner, and the asset allocation is the key. It's not a key, it's the key. It has to be there. So I absolutely agree with you, and that's the very good topic which you have chosen for the discussion today.
Okay, so sir is saying it as clearly as he can. It is the key to good investing. Feroze, your opening thoughts.
See, when it comes to investing, asset allocation is very critical, because that determines 90% of your fate of your money, point one. Point two, as longevity goes up of human beings, right? In India, the longevity of male Indian has gone up by 25 years from independence. Wow. So you have more number of years to live, and you will not work till the last breath. So you're going to be investing today to be able to live the same lifestyle you're living today. So it becomes even more important as longevity goes up. And thirdly, it's very important that you don't go for hot funds, like you said. Now, very, very important. See, you have to choose your objective. As an individual, do I want to make money or do I want to make wealth? You can get the best stock.
That's very interesting. Do I want to make money or do I want to make wealth? And what's the difference between the two?
See, to make money, you will have to take hundreds of several right decisions. Get this fund, you enter at the right time, you exit at the right time. You have to outsmart the market to make money. To make wealth, you have to out-discipline them. You can be the most disciplined person and you will create wealth. To make money, you have to outsmart people. That's a rat race which is very difficult to win. And you may get money, right? I buy the best stock. Let's assume I found a tip of a mutual fund. Let's speak of mutual funds. I buy that fund and it rose 20% in the next 1 year. Okay?
I made money. I'm happy.
I made money.
Yeah.
But if you put 1% of your wealth in it,
yeah,
that's just going to be party money for you.
Oh, if you've not thought through the whole investment.
Right? Can you put 30% of your money in a hot fund? You can't.
Yeah.
Right?
So that's I think something that we really need to think about. It's great food for thought as we start off. You know, I want to start with a very basic fundamental concept of knowing our risk appetite, our risk profile. And I don't think enough, gets discussed around this, because Mr. Singh, to be very honest, if you ask me, aap mujhse abhi puche, what's my risk profile or risk appetite? Frankly, I don't know if I have a very clear numeric scientific answer. The traditional wisdom used to be that the older you get, the lesser you invest in equities, the younger you are, you invest more in equities. But does that work anymore?
No, it's an outdated concept, honestly speaking. And taking cue from what Feroze has said, whether you are creating wealth or whether you are trying to get money. So that's not something which is true. And moreover, the risk appetite is not a static thing. It's a dynamic thing. Dynamic thing for what purpose, what is the objective, what for I am putting in money. If I am putting money for my children's capital creation and my child is 2 years old, my risk appetite is totally different. because I'm giving 16 years, 18 years, 20 years to that. But if my child is 16 years old and is going for higher education 4 years down the line, then the risk appetite for that fund has to be totally different.
Understood.
So that's something which is there. It's a dynamic thing. Don't think I'm a high risk appetite person or
exactly. I'm a low risk person or a high risk. It's not an intrinsic thing.
This is not the funda. And second point which you said, with the age growing, actually, when I look at the data, the maximum money is being put in equities by the people who are more than 55 years of age.
Oh my God. Okay, look at that. It's turned traditional wisdom on its head, right?
Because that is the money which people have accumulated.
Yeah.
They have put in money there, and they are there. This is not only the one. As Feroze said, the longevity is going up. They are keeping it for next 10 more years. When they will need to dip into it, maybe at the age of 65 or 70. So they have 15 years. They can be high risk appetite, right? But if you go by the old style, you cannot put more than 30% in equity at the age of 60, right? So that doesn't work anymore. And second and most important part is, see, sometimes the money is legacy money, right? This is for my next generation. Why should I put it in a conservative fund? The risk appetite for that is different. Risk appetite for a fund which I need for my sustenance is totally different. So we have to understand risk appetite has to be understood clearly for the objective. And second, asset allocation is the key. How much I have to put money overall, that is a different story to talk.
Okay, fair enough. So that's on risk. You know, Feroze, I want to club this with another thing that we've typically seen. So when we talk asset allocation, which basically means that should you be in equity, should you be in fixed income, should you be having more gold in the portfolio, along with, you know, the risk appetite part of it, another thing that comes into play is what is the market doing right now? So if gold has moved up 20%, suddenly you'll hear people talking about, "Arey, mera gold allocation kam hai. Maybe I should, you know, put little bit on gold." It's just human behavior and human psyche, right? How do we avoid it? What is the right approach? Risk and also looking at market movement, volatility. Should we ignore it totally? But then we're humans at the end of the day.
No, you can't ignore it completely, nor can you embrace it completely. If you have a strategic asset allocation, stick to that allocation in spite of the decibel of the noise you hear. It is like somebody playing music, but the room is filled with 100 people who are talking. You will not hear the music. So you'll have to cut the noise to hear the music. So how do you cut the noise is the most important thing, out of which some information is going to be important to you. So asset allocation, like DP sir said, is very critical. Now second, marrying your asset allocation with your risk appetite is a puzzle to solve. Most have not been able to solve, right? If I asked a client, what's the risk appetite? He is not or she is not able to articulate to me, and they're only using English words, saying that high risk appetite, low risk, medium risk. So to be able to marry the asset allocation with your risk appetite, you will have to make sure that you understand what are the types of risk which will impact which money of yours. I can't agree more with what DP sir said. In fact, that was food for thought for me. We classify ourselves as high risk, low risk, medium risk. Everybody with high risk can have some money in low risk. And somebody in the low risk category will have to have some money in a high risk portfolio if it is for his retirement or her retirement. So to answer your pointed question, I personally think that you should definitely try and marry your asset allocation with the risk appetite, and that's going to be critical. If you see some asset which has done very well over the last 1 year, you will always be tempted. See, I remember having done a show with you in 2017, 1st January, 2017 or 18. The largest portion of question was, can we not have crypto in our portfolio?
Because cryptos were the new hot thing in
absolutely.
town.
And I think the viewer also asked why, because that's called recency bias. That is a very important bias which we all as investors have to fight. We will be influenced by what happened in the last 1 year. That bias is called a recency bias.
Very important, and I guess going over, above and beyond those biases is the first stepping stone to have a disciplined, you know, statistical, mathematical, planned way of having a proper asset allocation in the portfolio. You know, we want to take some viewer questions as well, because we've got some queries on these lines. Subhashish Day has written in this question. This is a query we got in from Twitter. So keep sending those questions. We're, available on social media. Now, Subhashish is saying that, can you suggest some mutual funds for me which would have a low to moderate risk? I'm a beginner. I'm just starting out my journey. So therefore, I'm looking at moderate risk. This actually plays into what you gentlemen just said, that it's not like my blood group, that it's O positive or A or B minus, right? But the tendency seems to be that I'm a conservative investor, I'm a low risk investor, even though I might be a young person. So I need low risk funds. DP sir, what would your answer be, and what should the approach be for someone like Surabhi?
Again, coming back is the asset allocation, especially when he is starting his journey of investment. He should not do anything which he runs away from the market for a longer period. That's what we have seen in the past. People who are coming in the highest risk category when they are starting their journey and their longevity is less, they burn their fingers and don't come back to the market for a decade. The next generation comes and they enter into market. We don't want. So asset allocation through mutual fund rules, there are different categories of funds. There's a category which is called multi-asset allocation fund, which puts money in equity, which puts money in debt, which puts money in the gold or silver. So those are the categories which are there, and where the personal biases go away.
Sure.
Because fund manager is not supposed to listen to the noises in the market. He has to be disciplined. He will remain disciplined, and incidentally, I will call it incidentally underlined, these are tax efficient. Because tax efficiency should not be the reason for putting money there, but incidentally it is there. So your tax efficiency is better. Multi-asset allocation, I think for a beginner is the best choice.
So factors to keep in mind, Feroze, when you're looking at asset allocation, what are the most critical things that you should ask yourself, that you should evaluate before deciding debt, equity, gold, what you need?
So there's several factors, but I'll stick to only one factor to drive home the message. It's time. Okay, and generally a goal with longer periods of time should have equity. Why? Because there's not just market risk. Market ki utar chadav is what takes away mind share of an investor. But there's another risk, which is inflation risk, right? So that risk becomes a far more overpowering risk. If you had 100 rupees, okay, now whatever you could buy in 1980 with 100 rupees, today you need 4,800 rupees to buy the same commodity. Now you may be very happy that my 100 rupees has become 500 rupees in a fixed deposit. But if you take your 500 rupees to go buy that commodity, you don't get it. So time period is the most important variable, I personally think.
So we'll take a break on that note, but we continue this conversation on the other side. We also have lots of other viewer questions on this and how we should approach different types of fund categories that will help us achieve a better asset allocation. Back with that in just a bit.
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week, we are discussing the fundamental concept of asset allocation and why it's so critical when it comes to long-term returns from our mutual fund portfolio. Gentlemen, we've established the fact that we need to know our risk appetite, our goal, the time in the market in order to determine the right asset allocation. So that's step number one. Step number two is ki kare kaise, right? What's the approach? And here you can try and do it yourself by doing your own mix of equity and debt, or you can use the hybrid fund route. So DP sir, what is the right approach and what would you personally follow?
No, I think personally I will follow, and what is more advisable to the people is go through hybrid fund, not hybrid, because of the simple reason. One, you have to live away from your biases at a particular time. And you are not expert on what is happening in the market, what are the macro indicators are telling you, what call to take in debt funds, in the fixed income, whether which duration you should play in there. And then more than anything else is the tax efficiency.
Okay.
Because as of the tax laws today, whatever is happening within the fund, the income generated from that is absolutely tax free for the fund. If you are doing it individually, every time you rebalance, the tax liability will trigger.
Sure.
But if the fund manager is doing it on the behalf of investor, nothing triggers. The tax liability will trigger only when
you're selling the fund,
when he's selling the fund.
Yeah.
So that's the most important thing, and it's very, very important to understand. Unless and until you are fully hands-on, have the expertise thing, and you can do better than the tax efficiency part also, then you can do that. But this is extremely difficult.
Okay.
So hybrid fund is definitely the key, and that has to be there if you are doing that.
There's a query coming in on the dynamic asset allocation category. Let me quickly take this question. This is a query from Pankaj. Pankaj Katkar is asking this question, saying, how do I determine the taxation of a dynamic asset allocation fund? How would I know if it is above 65% in equity or below? And I think that's a great question because by nature, it's a dynamic fund. It keeps shifting between debt and equity. But you get equity taxation only when the equity component is more than 65% of the corpus. Great question, and thank you for asking this. DB sir, how does it work for these funds?
See, it used to be a problem actually. I mean, maybe people are not knowing whether it is more than 60%, whether dynamic asset allocation category. But today, if you look at it, most of the funds are in the balanced advantage category. The dynamic asset allocation 2 or 3 funds used to be there, but they have also converted into balanced advantage fund, where there is a certainty to the investor that it will be more than 65% only, so they don't have to worry.
Okay, so most of the balanced advantage funds are above 65%.
And how do they play that 65%? They may not be active into the equities 65%. They can play along with the arbitrage fund, which is the active category. In the active equity category, it comes, but at the same time, it doesn't have that kind of returns, that kind of risk. So people pay 40% active equity, 35% arbitrage, or 20% arbitrage, 45% equity. The fund manager is taking a call on that.
All right, sir.
As far as dynamic asset allocation fund is fair, yes, this is a problem. And if you are into dynamic asset allocation fund, the previous month's closing, what is the average that is available on the website, you can see that.
Okay.
But
it might change the next month.
Yeah, it might change. But looking at the ease of for the investor and everybody, I don't even remember there is even one dynamic asset allocation fund which is changing like this.
That rapidly.
So everybody is going into balanced advantage category, which is 65% plus only.
It gives you great equity taxation. Just to complete this topic, Feroze, since you brought up this point that a lot of young investors are coming in, and that fixed income part of their portfolio, they'll probably not touch it for a good 7, 8, 9, 10 years, right? So instead of putting money in a pure fixed income fund or leaving it in your bank deposit, if you were to play fixed income through the hybrid, more tax efficient route, then give us 2 or 3 funds, categories, I mean, at least the category prototypes that you think make great sense if you don't need that money for at least 5 years.
See, I think hybrids most of the hybrids have become tax efficient. Because like DP sir said, even the 35% equity guys get taxation of equity long term, 12.5, after 2 years. So as long as...
Within hybrids, because there's conservative hybrid, there is balanced advantage. There's so many different types of hybrid funds, right? So it's a little complex for the investor.
If you are a young viewer, be rest assured that debt is more risky in the long run than equity. Debt is the riskiest asset class where you are sure to lose. If you're going to own something for 10 years and you're sure to lose the purchasing power of your money, there are very few risks which can be near certainty. This is post-tax, you will surely not beat inflation in debt in a country like ours.
So you should not be in debt for 10 years if that's your time horizon.
Only like young people might also, like DP sir's point, again, sorry, I'm reiterating, if there is a young person who wants to buy a car in 2 years, that's a separate portion of the money. That you have to be conservative. You can buy an arbitrage fund or a very conservative hybrid fund if you have 3 year plus.
Okay.
One point I'll say, in the category, as you put in, there's only one category which is little tax inefficient today, which is a conservative hybrid fund.
Okay.
Because conservative hybrid fund, you are not supposed to put more than 25%. And if it is less than 35%, you get the marginal rate of tax. So that is there, but you will get the growth of 25%. So though for the people who are there in the lower tax category, who are into 20% category, who are into 10% category, which most of the retirees at the mid-level are, this is the best product for them. They're getting very less risk, but their marginal rate itself is 10%, 20%, 30%.
Right.
This is good for them.
Got it.
Okay, but for the highest the tax category people, then you have to go to either 35% category, which is all multi-asset fund, multi-asset allocation fund, or equity savings fund, or balanced advantage fund, or equity hybrid fund. These are the 4 funds which come into that category, 1 year or 2 year.
Got it.
So multi-asset allocation is typically into the 2 year category. Others are equity saving, can be 1 year, can be 2 year, depending upon the equity allocation. But balanced advantage fund and equity hybrid are into the equity category.
They get the equity advantage, equity taxation advantage. Okay. I think we have time to squeeze in one more viewer question. Samrat Datta, he is calling us. I think he's from Bengaluru. Samrat, welcome to the show. Tell us, how can we help you?
Hi, I'm Samrat from Bangalore, and my question is, keeping a long-term horizon of 20 years for SIP, what should be the ideal mix of the portfolio with max 4 mutual funds in it? this money can be used for building a retirement corpus? Thank you.
Okay, all right, Samrat, let me toss that to Feroze straight away. 20-year SIP money. He's saying, give me, 4 funds.
See, firstly, I think if there is a retirement objective, try and marry your objective with the objective of the fund. Now, DP sir is here, and incidentally, SBI is the largest asset management company in the country, right? Yeah. So, and it's the only asset management company in my model portfolio has 3 schemes. Okay, never has it happened in the last 12 years we've had it. So, leaving that apart, so like you have an SBI retirement fund. Okay, if you marry these 2 objectives, you're more or less certain that the fund manager is also looking at really long term. What is happening of late is diversified equity funds have this tendency wanting to beat their counterparts every single month. Your objective is 20 years, right? A retirement fund will not be so hell-bent on trying to beat its benchmark or its peer group every 1 month, every 2 months. So
let me actually bring that to DP sir as well, because it's a great question that if I want to build a corpus over 20 years, I can go in a diversified equity mutual fund. Then why should I look at a retirement solution fund?
See, diversity equity fund, what the Samrat's query is basically that he's putting it for 20 years. So he's going into a fund where the uniform investor base is there who are putting money for a longer period. So the fund manager's way of investing will be different from an active equity fund where he has to look for the redemption also on day-to-day basis. He has to look for the liquidity in the fund, has to look for then as Feroze said, every time there's a pressure that this quarter I have to beat not only the benchmark but the peer set also. But then the retirement fund, when you are very objective, concentrated, good businesses, good stocks, you have created a portfolio, you need not be worried about. That portfolio over the period of 3 years, 5 years, 7 years will keep on giving the very good return. But only thing, keep on reviewing the portfolio, keep on reviewing the fund's performance at least every 3 years. Don't look at it every day.
Okay.
So this is a 3-year unit. You should look at the position of the fund.
Okay, fair enough. Fair enough. I think
Surabhi, can I add one word of caution?
Absolutely. And the final
Whenever
word.
you look at a fund which is a locked-in fund, stick to the top 2 AMCs. Because you would want to have the kind of depth in analyst which can stand the test of time.
Sure.
Like, I would look at not beyond the top 3 if I'm locking in my money.
Okay, fair enough. We've run out of time, but not out of questions. But I think it's a great starting point. Asset allocation is something we need to keep in mind. We need to be disciplined in our approach and look at our goals and try and find solutions depending on the goal that we are trying to meet. Got it. Thank you so much, gentlemen, for joining in. Great to have both of you in the studio for this conversation.
Thank you so much. Thank you, sir. Always a pleasure to be here.
Wonderful to have you, sir. Well, with that, it's a wrap on this edition of Let's Talk Money. Keep sending us your questions, your feedback, comments, and queries. We'll see you again next week.
Let's Talk Money